What if I were to suggest that the impending economic downturn facing America is not merely a recession nor even a depression, but something far more peculiar, an experience utterly unprecedented for our nation? This phenomenon carries a name that sounds almost too outlandish to be true: stagflation, depression. Let that concept resonate for a moment. Envision the bleak unemployment queues of 1929, when a staggering 1 out of every 4 Americans found themselves without work. Now superimpose upon that image the unnerving reality of 1975's grocery aisles, where mothers witnessed prices escalate week after agonizing week. Combine these two distinct anxieties into a single point in time, and you begin to grasp the quiet buildup occurring beneath the surface of our present economic landscape. What makes this situation so deeply unsettling is this: during the Great Depression, as people lost their jobs, the cost of goods actually decreased. Bread was affordable because no one possessed the means to purchase it. In the 1970s stagflation era, individuals retained employment, but their earnings lagged far behind the rapidly climbing cost of living. Both of those difficult periods, while harsh, offered a certain perverse form of relief. You either lacked funds while prices remained low, or you possessed some income while expenses surged. A stagflation depression offers no such solace. You face job loss concurrently with exorbitant costs for everything. Imagine being made redundant next year, only to enter a supermarket where eggs fetch $8 a dozen. Your unemployment benefit arrives, yet it barely covers your rent, which your landlord has just increased due to their own spiraling expenses. You attempt to sell your home to stay financially solvent, but the housing market has cratered because no one can afford mortgages at a 9% interest rate. The equity you painstakingly built over 15 years has vanished, and the cash you would receive wouldn't sustain you for 3 months anyway. This is not an exercise in alarmism, it is an act of pattern recognition, and the patterns are shouting. Allow me to present the initial piece of this complex puzzle. Let us journey back to October of 1929. America had just emerged from the exuberance of the Roaring Twenties, a decade characterized by readily available credit, soaring stock valuations, and an unshakable conviction that prosperity was eternal. Does this sound familiar? Financial institutions had liberally distributed loans throughout the nation. Consumers acquired everything from automobiles to radios through installment plans. Speculators borrowed funds to invest in the stock market, subsequently leveraging those same stocks as collateral to secure even greater loans. Then, the music abruptly stopped. The stock market did not merely falter, it experienced a precipitous decline of nearly 90% over a period of 3 years. However, here lies the crucial insight that eludes most observers of 1929. The collapse itself was not the primary catastrophe. The debt was. As asset values plummeted, all those outstanding loans suddenly became unrecoverable. Banks failed by the thousands. Credit dried up overnight. Businesses reliant on borrowing to meet payroll obligations were forced to cease operations. Data from the Federal Reserve from that era reveals a contraction in the money supply exceeding 30%. Prices fell, wages declined, and unemployment climbed to 25%, all because the entire economic framework had been constructed upon a bedrock of borrowed funds that had suddenly evaporated. Now consider our present circumstances. According to the Federal Reserve Bank of New York, American household debt has surpassed $17 trillion for the first time in history. Our national debt has soared past $34 trillion. Corporate debt has doubled since the year 2010. Student loans, car loans, credit card balances, all are at record highs. We have effectively reconstructed the debt architecture of 1929, but on a scale that is both larger and more interconnected than anything the world has ever witnessed. That represents the first formidable obstacle we are hurtling towards. But herein lies the truly unsettling aspect. Let us now transport ourselves to 1973. America remained the preeminent global manufacturing force. Our factories hummed with activity, and our workers felt secure in their futures. Then, the oil embargo struck. Arab nations deliberately curtailed supply. Suddenly, the very energy that powered all of American industry, our vehicles, our manufacturing plants, our heating systems, our entire way of life, became both scarce and prohibitively expensive overnight. What ensued was a decade of hardship that Federal Reserve economists continue to analyze meticulously. Inflation did not merely edge upward, it surged dramatically, exceeding 14%. However, this was not the typical inflation stemming from an excess of money pursuing insufficient goods. This was supply shock inflation. The essential commodities required for our economy to function were simply unavailable in the quantities we needed. Consequently, prices skyrocketed even as economic growth stagnated. The 1970s imparted a somber lesson. When supply chains fracture, when essential goods become scarce, and when the global systems upon which we depend disintegrate, controlling inflation through conventional methods becomes nearly impossible. Now turn your attention to our contemporary world. The era of inexpensive globalization is demonstrably drawing to a close. We are currently observing the nascent stages of what economists at the Bank for International Settlements term geoeconomic fragmentation. Trade conflicts have become the prevailing norm. We are initiating the reshoring of supply chains, an endeavor that sounds patriotic until one acknowledges that the cost of labor in America is 7 times that in China. We are imposing sanctions on major commodity-producing nations, restricting technology exports, and witnessing our traditional allies hedge their commitments by fostering closer ties with our adversaries. Pop quiz. What transpires when a global economy meticulously engineered for maximum efficiency and the lowest possible production costs is deliberately dismantled for geopolitical objectives? The outcome is persistent supply disruptions. The semiconductor shortage that crippled automobile production in 2021 was merely a precursor. The surge in energy prices following the conflict in Ukraine vividly illustrated how swiftly costs can cascade through every economic sector, and the escalating tariffs we are currently witnessing are not temporary negotiating ploys. They signify a fundamental reconfiguration of global trade flows. The 40-year period of declining real costs for manufactured goods is concluding, and there is absolutely nothing on the horizon to suggest its resurgence. Therefore, we confront a terrifying confluence of factors. We have constructed a debt-laden powder keg reminiscent of 1929, laden with trillions in obligations that can only be serviced if asset values remain elevated and interest rates stay low. Simultaneously, we are orchestrating supply chain disruptions akin to the 1970s, which will inevitably drive prices upward for years to come. These two forces have never converged with such magnitude in the history of the United States. In 1929, we experienced a debt crisis, but no supply crisis. In fact, prices actually declined. In the 1970s, we faced a supply crisis, but no debt crisis. We possessed the capacity to raise interest rates to 20% because our debt-to-GDP ratio stood at a mere 35%. Today, according to the Congressional Budget Office, that ratio exceeds 120%. We represent the inaugural generation of Americans to confront both of these formidable challenges concurrently. The ramifications are profound when projected onto your personal circumstances. Your retirement portfolio, likely structured according to the conventional guidance of stocks and bonds, faces simultaneous devastation from both directions. The value of your home equity is contingent upon housing prices, which necessitate functioning credit markets. Your job security depends on corporations that have profited immensely from inexpensive debt over the past decade. Your purchasing power assumes stable prices for food, energy, and the fundamental goods your family requires. Each and every one of these assumptions is poised to be rigorously tested in ways not observed since the time of our great-grandparents. This is not a distant threat. The mechanisms are already in motion, and in the upcoming moments I will elucidate precisely why our central bank, the institution entrusted with preventing economic calamities for over a century, is utterly incapable of averting the impending crisis. They are ensnared in a predicament from which there is no escape, a checkmate scenario where every potential action exacerbates the situation. However, before we delve into that, it is imperative to understand precisely how we arrived at this impasse and why the emergency exits we have consistently relied upon have been quietly sealed shut. Imagine for a moment being in the position of the Federal Reserve Chairman today. Each morning, you enter your office confronted with a decision that would challenge the wisdom of Solomon. The instruments available to you have proven effective for a century, yet today they have transformed into instruments of destruction irrespective of your choice. Herein lies the stark simplicity of central banking, a fundamental principle that every economic student encounters in their initial semester. When inflation escalates beyond acceptable levels, interest rates are elevated to temper economic activity. Conversely, when recession looms, interest rates are reduced to encourage borrowing and spending. This established strategy functioned admirably for decades because America typically contended with a single economic challenge at a time. But what occurs when both crises manifest simultaneously? This is the predicament, and there is no ingenious resolution. Let us examine the dire scenario currently unfolding in Washington. Inflation persists above the target rate, diminishing your purchasing power with each passing month. Data from the Bureau of Labor Statistics indicates that cumulative price increases since 2020 have surpassed 20% for most essential household goods. Your grocery bills, insurance premiums, and utility costs have all risen dramatically compared to just 4 years ago, and these increases are irreversible. The textbook response is straightforward. Increase interest rates until inflation is subdued. This is precisely what Paul Volcker did in 1980 when he elevated the federal funds rate to 20%, effectively vanquishing the stagflationary monster. It was a painful process that precipitated a recession, but it was effective. Inflation plummeted, and America entered a 20-year period of economic expansion. So why cannot we simply replicate that success? Because in 1980, our national debt stood at approximately $900 billion, roughly 33% of GDP. The federal government possessed the capacity to absorb higher interest payments without undue strain. Corporations were not excessively leveraged. Households carried manageable mortgage and consumer debt burdens. Today, according to the Treasury Department, our national debt exceeds $34 trillion, over 120% of GDP. Every single percentage point increase in interest rates adds hundreds of billions to our annual interest expenditure. We are already allocating more to debt servicing than to national defense, and this disparity widens each quarter. To articulate this in plain terms, if the Federal Reserve raises rates sufficiently to truly crush inflation, the interest payments on our national debt would consume the entire federal budget within a matter of years. We would be compelled to choose between compensating bondholders and funding Social Security, between servicing our debt and maintaining our military capabilities. The government itself would face a solvency crisis. However, this pertains only to the public debt. Corporate America amassed over $10 trillion in debt during the era of cheap money, much of it at rates close to zero. American households collectively owe $17 trillion. When interest rates are aggressively increased, the objective extends beyond merely combating inflation. It involves detonating charges beneath the entire debt structure upon which our economy is predicated. Banks begin to fail as their loan portfolios deteriorate. We have already witnessed the collapse of 3 major regional banks in 2023, and that was merely a prelude. Corporations that borrowed to engage in stock buybacks and distribute dividends will suddenly be unable to refinance their debt, leading to widespread layoffs affecting millions. Homeowners with adjustable rate mortgages will face payments they cannot possibly afford. The result is a scenario mirroring 1929, a deflationary debt spiral where asset values plummet, credit freezes, and unemployment skyrockets. This is not attributable to some external shock, but rather to the overwhelming burden of accumulated debt finally becoming insurmountable. Consequently, the Federal Reserve resorts to the alternative, lowering rates, injecting money into the system, and implementing bailouts. This is precisely what occurred in 2008 and again in 2020. The economy is inundated with liquidity. Every failing institution receives backing, and the hope is that the stimulus generates sufficient growth to outpace the debt. The complication this time, however, is the simultaneous occurrence of a supply crisis. All the newly injected money chasing a diminished supply of goods does not foster growth. It engenders hyperinflation. Consider the situation in the Weimar Republic in 1923. Germany was burdened by crushing war debts it could not repay. In response, it printed money to meet its obligations. Within months, prices were doubling every few days. Workers received their wages twice daily and rushed to stores during their lunch breaks, as their morning earnings would be rendered worthless by evening. Life savings evaporated, the middle class was decimated. While we have not yet reached that point, the underlying mechanism is identical. When money is printed into a supply-constrained economy, production is not stimulated. Rather, the prices of available limited goods are inflated. This represents the checkmate position. Elevate interest rates and trigger a depression. Print money and trigger hyperinflation. Every available path leads to a catastrophe of one form or another. And here is the aspect that should genuinely unnerve you. For the bottom half of America, the depression has already quietly commenced. The official unemployment rate hovers near historic lows, which might sound reassuring until one examines what this figure actually represents. It classifies a gig worker performing 2 hours of food delivery as fully employed. It completely disregards the millions who have simply ceased seeking employment altogether. According to broader measures employed by the Bureau of Labor Statistics, real underemployment figures are significantly higher than the headline number suggests. Meanwhile, the Department of Housing and Urban Development estimates that over 650,000 Americans experience homelessness on any given night, the highest number ever recorded. Demand at food banks has surged to levels not witnessed since the most severe phase of the pandemic. However, now, without the pandemic-era government support, Feeding America reports that 1 in 7 Americans relied on food assistance last year. Real wages paint an even more discouraging picture. When adjusted for actual inflation rather than the government's carefully managed metrics, data from the Federal Reserve Bank of St. Louis indicates a decline in purchasing power for median workers over the past 4 years. You are working the same hours, perhaps even more, yet affording less. For tens of millions of our fellow citizens, these statistics do not foretell a future crisis. They represent their current daily reality. The depression is not approaching for them. They are living within it. While the financial media celebrates record highs in the stock market, propelled by a select group of mega-cap technology corporations, this divergence between Wall Street and Main Street is unsustainable. And when the financial economy inevitably converges with the diminished state of the real economy, the collision will be severe. So when will this economic bomb ultimately detonate? What will be the catalyst that propels the crisis from a slow burn to an abrupt collapse? The answer resides within corporate finance departments across America at this very moment, and it is associated with a very specific deadline. Between 2020 and 2021, something extraordinary occurred within the corporate landscape. Interest rates had plummeted to near zero, prompting companies to embark on the most substantial borrowing spree in history. They issued trillions in bonds, secured massive loans, and locked in those impossibly low rates for periods ranging from 5 to 7 years. At the time, this strategy appeared exceptionally shrewd. Why not borrow at 2% when inflation alone would diminish the real cost of repayment? Chief financial officers nationwide heavily leveraged their balance sheets with this cheap debt, utilizing it for stock repurchases, acquisitions of competitors, and dividend payments that kept shareholders satisfied. However, 5 to 7 years from 2020 brings us to a remarkably precise window. According to data compiled by Moody's and research from Bank of America, over $2 trillion in corporate debt is scheduled to mature in 2025 and 2026. This is not a gradual process. It is an impending wall. Herein lies the formidable challenge these companies now confront. The debt they procured at 2 or 3% requires refinancing at current interest rates, which are 3 to 4 times higher. A company that was previously obligated to pay $50 million annually in interest now faces a $200 million bill for the same debt load. This additional capital must originate from somewhere, and for a significant number of corporations, it simply does not exist. The Federal Reserve's own research on corporate vulnerability reveals that approximately one-third of publicly traded companies do not generate sufficient operating income to cover their interest payments at prevailing rates. These are commonly referred to as zombie companies, and they have effectively been operating as the walking dead for years, sustained solely by the availability of cheap money. When the refinancing wall arrives, they will finally succumb. Widespread layoffs will follow corporate defaults with the same inevitability as thunder follows lightning. When businesses are incapable of servicing their debt, they implement cost-cutting measures, and payroll consistently represents the most substantial expense. Economists at Goldman Sachs project that a corporate debt crisis could trigger unemployment surges comparable to those experienced during major recessions. The crucial difference this time is that it will occur while inflation remains persistently high. That is the trigger event for 2026, not a prediction of impending doom, but a mathematical certainty embedded within the debt maturity schedules that are currently discernible. So, what does this signify for your personal finances? Let us address a strategy that financial advisors have advocated for decades: the balanced portfolio. You have likely encountered the conventional recommendation of 60% stocks and 40% bonds. The underlying theory is elegant. Stocks offer growth during periods of economic expansion, while bonds provide a safe haven during downturns. As one asset class performs, the other retreats, thereby safeguarding your overall wealth. This approach proved remarkably effective for 40 years. However, it was conceived for a world where we faced either inflation or recession, never both concurrently. In a stagflation depression, the 60-40 portfolio transforms into an inescapable trap. Your equity allocation will be decimated by the depressionary component. When unemployment escalates and corporate earnings collapse, stock prices will inevitably follow suit. The S&P 500 experienced a decline of nearly 90% between 1929 and 1932. Even during the comparatively milder crisis of 2008, stocks fell by over 50%. Under normal circumstances, this is when your bond allocation would provide a crucial buffer. Historically, during stock market downturns, investors have sought the security of treasury bonds, driving their prices upward. However, within a stagflationary environment, bonds offer no sanctuary whatsoever. When inflation runs rampant, bonds become highly detrimental investments. A bond yielding 3% while inflation stands at 8% means you are incurring a 5% loss of your purchasing power each year, guaranteed. Bond prices will plummet because no rational investor wishes to hold an asset that is demonstrably eroding in real value. During the stagflation of the 1970s, long-term treasury bonds lost over 40% of their real value. Consequently, visualize the worst-case scenario. Your stocks are down 40% due to the recession, and your bonds are down 30% due to inflation. Your supposedly safe, diversified portfolio has just depreciated by over one-third of its value. And within this portfolio, there is no asset class offering any form of protection. This is not mere speculation. It is precisely what transpired in 2022 when both stocks and bonds declined simultaneously for the first time in decades. That event served as a mere preview of the impact a genuine stagflation depression has on conventional paper assets. However, here is where the situation becomes intriguing. While financial assets are being systematically eroded from both sides, certain categories of real assets have historically flourished in precisely such an environment. Consider the fundamental implications of a stagflation depression from an asset perspective. Prices for tangible goods are soaring, while the value of financial assets is collapsing. The items you can physically touch, utilize, and consume become inherently more valuable precisely because the currency used to measure them is losing its credibility. During the 1970s stagflation, gold did not merely preserve wealth. According to historical price data, its value increased more than 20-fold from the beginning to the end of that decade. Commodity prices in general experienced a surge because physical goods emerged as the ultimate store of value when paper assets were rapidly depreciating. In the Great Depression, a different array of assets demonstrated resilience. Farmland retained its value far more effectively than urban real estate or financial instruments because it produced something indispensable: food. Businesses possessing genuine cash flows, where revenues consistently exceeded expenses, continued to operate while their leveraged competitors faltered. Properties with fixed-rate mortgages secured prior to the crisis became exceptionally valuable because the debt burden remained constant while competitors faced imminent credit extinction. Now contemplate what assets possess the capacity to endure both scenarios simultaneously. You require assets that are inherently scarce, as scarcity provides a hedge against inflation. As expenses climb across the board, your limited resources are escalating in value even more rapidly. You require assets that are indispensable, as their essential nature acts as a shield against economic downturns. Consumers will forego discretionary purchases, but will always procure what they fundamentally need. Precious metals fit both criteria. For 5,000 years, gold and silver have served as safeguards for wealth due to their inherent scarcity. The World Gold Council reports that central banks have been acquiring gold at unprecedented rates in recent years, indicating that even governments are anticipating future economic shifts. When the very institutions responsible for issuing currency are accumulating gold reserves, it signals a profound lack of confidence in fiat money. Productive real estate, especially agricultural land, also meets these requirements. The availability of farmland is finite, and the demand for sustenance is perpetual. During the most severe phases of the Great Depression, farms that maintained consistent food production retained their value, while speculative urban developments plummeted to worthlessness. Energy resources also satisfy these conditions. While we may transition to alternative energy sources over several decades, hydrocarbons remain vital for a myriad of near-term needs, from transportation and fertilizer production to heating. Businesses that possess actual reserves of these resources hold tangible assets independent of complex financial instruments. The unifying characteristic among these resilient assets is their tangibility. They exist independently of the financial system, their worth not predicated on trust in central banks or the financial stability of other parties. They yield or contain something the real economy genuinely requires. This doesn't imply a singular focus on gold, stored away without consideration for broader financial planning. Diversification remains crucial, so too does liquidity. Your personal circumstances, including your liabilities, the steadiness of your income, and your investment time frame all play a role in determining the optimal strategy. Nevertheless, the overarching strategic realization is evident. The period that favored intangible assets and financial maneuvering is drawing to a close. A new era, one that values tangible worth and genuine production, is commencing. We are presently at a pivotal juncture. It's one of those infrequent moments when the fundamental rules of economic engagement undergo a profound transformation. Behind us lies a 40-year span characterized by diminishing interest rates, readily available credit, and financially driven prosperity. Ahead lies a reality unfamiliar to our generation, a world where capital is constrained and tangible assets hold significant value. The era of inexpensive money has conditioned us to adopt a specific mindset: borrow at low rates, acquire assets, witness their appreciation, refinance, and repeat. This approach is poised to become not only financially detrimental, but actively hazardous. The strategies that built wealth for your parents' generation could very well dismantle wealth for yours. This is not about instilling fear, but about fostering preparedness. The Americans who navigated the aftermath of 1929 successfully were not those who ignored the unfolding crisis. They were the individuals who recognized the reality of the situation early on and adjusted their positions accordingly. The families that preserved their purchasing power through the 1970s were not merely fortunate, they understood the erosive impact of inflation on paper assets and made informed alternative choices. You are receiving this guidance now, prior to the looming challenge of debt refinancing and the full manifestation of the economic crisis. This presents an advantage that prior generations lacked. They learned these critical lessons through hardship and loss. You have the opportunity to acquire this knowledge through informed awareness. The era demanding difficult decisions has arrived. Interest rates cannot return to zero without fueling rampant inflation. Debt cannot continue to expand without incurring inevitable consequences. Supply chains cannot be instantaneously reconstituted. The imbalances that have accumulated over decades will be rectified over the coming years, and this process will undoubtedly be challenging. However, challenging does not equate to unsurvivable. It signifies a fundamental shift. Different proficiencies will gain prominence. Distinct assets will retain their value. Alternative strategies will ensure security. The question is not if this transition will occur. The debt obligations, the disruptions to supply, the predicament faced by central banks, these are not abstract predictions but present realities. The sole question is whether you will enter this new era with clarity or with willful ignorance. Consider this a navigational chart. The path ahead may seem unfamiliar, but it is not impassable. The Americans who confronted 1929 and the Americans who faced 1973 found their way forward. We will too, but only if we are willing to perceive honestly, adapt pragmatically, and prepare judiciously while the opportunity still exists. The countdown toward 2026 is underway. The predicament is established. However, you have just witnessed the mechanics of this situation, and that understanding represents the initial step toward ensuring your safety when the inevitable occurs.